And will the lack of recent data make the Fed's decision any harder? For more on this, we're going to turn to Tiffany Wilding, PIMCO Managing Director and Economist. Tiffany, thank you for joining us here. So we were just listening to Shauna point out some of the dearth of economic reports for the month of May or even April that we're probably going to be looking at. Explain the Fed's conundrum here, and particularly in light of the fact that we're just coming off a bank crisis.
Yeah. So I think overall, just taking a step back, the Federal Reserve obviously takes in data as it comes, but it's not exactly the data. It's how the data impacts their forward-looking forecasts that really drive monetary policy decisions. And I think the issue here is there's still a lot of uncertainty around how the banking sector stress that we saw in mid-March will impact the outlook. And we haven't, unfortunately, got a lot of, data and reports to kind of understand the possible magnitude of that. So I think that's really what the Federal Reserve is going to have to deal with. I think they know the direction, that the effect will have. In other words, this should cool loan growth. It should be a drag on GDP growth. Ultimately, that will flow into labor markets and inflation. But again, really, it's the magnitude here that matters. So in the interim, the Fed is still in this period of trying to decide, whether the focus should be on risk management to elevated inflation or, some of the banking sector stress. And I think given that we've seen this banking sector stress kind of die down, their focus is probably going to be on inflation. It's probably going to lead them to another rate hike, absent, again, anything sort of popping up in the interim.
So, Tiffany, then if we do get another rate hike, and talking about some of the data points that we will get here over the next couple of weeks ahead of that next decision in May, what do you think is necessary for the Fed to eventually either hold steady or pivot if we do see that before the end of the year?
Yeah, well, whether they hike again in May or not, we think they're effectively pretty close to being done here. And the data that we look at more recently, high frequency data that looks at credit card spending, or even some leading indicators for the labor market, really suggest to us that we are seeing a pretty meaningful deceleration in activity and in spending, and ultimately in hiring. We obviously heard from a lot of large companies around the turn of the year that they were laying off significant amounts of people. We think that the effective dates for when those people actually get laid off are actually around the turn of the month here, so around at the end of March. So that might not get picked up in the government data, the payroll reports, until the April report. But we do think it's happening. So I think there is a deceleration in activity that's happening that will continue as small businesses aren't, it's going to be more difficult for them to get loans. Obviously, rates are higher, financial conditions just generally tighter. So we do think you are going to see a modest recession probably start later this year. But in terms of what it takes for the Fed to, not only to stop but actually ease policy, I think unfortunately here it's still going to take inflation coming down. Inflation lags broader growth, fundamentals. And so there's going to be a bit of a lag time when growth decelerates before inflation, really starts to, more convincingly come down towards target. So, that's kind of the dynamic that we're going to have to deal with. The Fed's probably not going to be as quick or as aggressive to ease as what we've seen in the recent past, to the pandemic or even to the 2008 financial crisis.
Nevertheless, when the Fed cuts, it usually cuts pretty quickly, and the market has a difficult time predicting exactly when that inflection point is going to be. Just wondering, because we've seen since the Fed started getting hawkish about a year ago, I would say market participants have been very quick to price in these cuts. Do you think the market is finally starting to get it right now, where we have potentially cuts coming in towards the end of the year? Just wondering, in terms of timing, do you think finally it's time to start thinking about that Fed pivot when it really hasn't been in months and quarters past?
Yeah. Well, just to, some historical context, which I think is helpful, but if you do look over the hiking cycles historically, what you find is that when the central bank in the United States, at least, gets to the top of the hiking cycle, on average, it's been around 6 to 7 months that they spend up there, and then they start cutting, and then kind of on average in the year when the cuts, in the year after the cuts start, they have cut by about 300 basis points, and obviously many hiking cycles, it's more like 500 basis points are full cuts. So yeah, I mean, I do think that the fact the market is pricing in cuts and it has, I think, is completely consistent with that historical, just analog and precedence. And it's reflective of the fact that financial conditions are tight. And, it's very difficult for the Fed. They're trying to slow down activity. They're trying to engineer demand lower. And with the blunt tools that they have, it's very difficult to do that in the kind of maybe fine-toothed way that, they might hope that they would be able to. Now they've argued over the last year that they are targeting a, quote, soft landing. Our own forecast suggests going to be soft-ish. We do think you see a modest recession. The unemployment rate, is going to rise. But nevertheless, I guess we would also argue that we don't think we're on the precipice of a 2008 style event here. Even in the context of some of the banking sector stress, there are, some positives about the economy that probably provide some supports, and that is excess savings on consumer balance sheets. And on average, the large banks are very well capitalized, and actually state and local government spending, we think is actually probably going to be very resilient as a result of federal government outlays towards infrastructure spending, as well as some other things. So, there's some good and bad things here. I think overall it kind of suggests to us that, modest recession, still likely inflation coming lower. And in that kind of environment, the Fed can ease and start to ease potentially by the end of this year.
Tiffany, what's your reading just on business sentiment? Because when you take a look at the most recent ISM surveys, it seems to be possibly declining just a bit. If that is also true, then how do you then see that affecting the jobs market down the line? Is it going to lead to maybe more cautious hiring pattern here over the next couple of months?
So you're right. The purchasing manager surveys, did fall. The latest ones did suggest that things were, slowing and even contracting in the manufacturing sector. And ultimately, I do think these banking sector issues will spill over effectively into the job market because small banks tend to be the biggest lenders to small businesses. And small businesses are very important to the broader economy and very important to hiring. In the post-COVID, recovery that we've had, it was really the recovery for small businesses, that generated a lot of the hiring that we saw. So I do think as you have these smaller businesses that, maybe it's more difficult for them to get loans, they just aren't going to be able to hire the people or open, that new, branch or shop or what have you. And again, that's going to slow hiring. And we could potentially see a contraction in hiring as a result of that as well.
All right. We got to leave it there, but really interesting insights. PIMCO's Tiffany Wilding, thank you.